Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. And what we do to value sectors is we use ratios. We use a gold to oil ratio, gold to uranium ratio, gold to natural gas. At least that's how I value a lot of these commodities. When the commodity to stock ratio turns green, which we do have a buy signal, I start looking at all of these ratios to see what sectors would be good to enter. And I'm going to go over the energy sector and the precious metals sector of some of my favorite investments, the sectors, and show you what I'm seeing versus previous bull markets and history. So I'm going to show you the low or the cheapest that the ratio has been in our recent bull market. I'm going to show you the high or the most overvalued ratio in previous bull market. We're going to see what that could potentially be in a total return for the commodity. Then we're going to look at the current gold to oil, gold to uranium ratio, see what's left in the valuations. And if you're playing the mining companies or royalty companies, obviously these are leveraged to the price moves of the commodity. So it might be 2, 3, 4x the multiple of the commodity move. Another thing to keep in mind is that the energy sector, natural gas, uranium, and oil, usually peak earlier against gold than, say, silver and platinum. So the multiples that oil, uranium, and natural gas are going to look much higher because they're being priced against a much lower gold price. So for example, if gold were to go to $10,000 an ounce, uranium might peak, or oil, against gold earlier in the cycle. So it might only be $4,000 an ounce of gold that it peaks against. So if you have the ratio and you're ratioing it against a much lower number, your total return may not be as big as you think it might be versus a lower ratio that peaks against gold at the top of the market. So for example, if you go to a 1 to 10 ratio and gold's at 4,000, it'd be $400. But if gold's at 10,000 and you do a 1 to 10 ratio, it's $1,000. So it depends where you're pricing things against each other. Then the energy sector gets priced and it peaks usually earlier in the gold cycle, and the precious metals peak at the end of the big move against gold. So I just want to make sure that you guys know that. And again, I don't use leverage. I'm unleveraged. I don't use any margin. Don't have any loans. I don't have any of that stuff, guys. I ride this. These are super volatile. Mining companies, royalty companies, they're all very volatile. So I ride them to stay in it. If you use margin, if you're borrowing money, you could be put in situations where you have to sell. And that's not favorable. So here we go. Let's jump in here. So I've got at the top here the gold to oil ratio. The gold to oil ratio peaked at 148.5. That's incredibly cheap. We've never seen it that cheap in history. A cheap ratio is roughly 30. Anything above 30 and you are killing it in terms of buying oil at that price. We came back down and we hovered around the 40s and 50s. This was ultra awesome to buy a bunch of oil during this entire time frame. And then you can see that the ratio started to compress. This compression in the ratio is what shot oil higher. So looking at the high of 148.5, last bull market in 2008, it was the most overvalued and it got to 6.5 barrels to 1 ounce of gold. The multiple of this commodity is 22.85 if it were to repeat its bottom again. That's 148 divided by 6.5. Uranium got to a high of, I think, around 62 pounds to 1 ounce of gold. The most overvalued spot is a 1 to 3 ratio. If you were to take 62 divided by 3, you get a 20.6 times the uranium price multiple from the bottom. Natural gas peaked out at 1163, and it hit a low of last bull market of 66. 1163 divided by 66 is 17.6. All of these energy plays had incredible values at their bottom. Now, what's left of the ratio? We are at 25.7 for oil. I want to go down to natural gas is at 362. And uranium, if you calculate it, is at 42. If you were to take 42 divided by 3, you get 14. 25.7 divided by 6.5, 4. And these two numbers, 5.5. Uranium still has incredible value in terms of its uranium price in relationship to gold. It is still probably one of the best commodities to buy in terms of valuation. So that is a positive. 4 and 5.5 are still good compression numbers. These are all incredibly undervalued. We just came from ridiculous numbers over here and the ratios. They've never been this cheap in history. Looking at the silver to platinum ratio, I would say that these have also never been this cheap in history. We have 131 for silver. And on the bottom here, platinum, we got to a bottom of 0.3781. We're at 0.534 and at 75. So I put those in this chart here. I did the high divided by the low, and the multiple of the commodity is 4.4 for silver and 5.4 for platinum. What's left on the ratio is about 2.5 for silver and 3.7 for platinum. Platinum is still an incredible deal, and so is silver. Now, I want you to keep in mind that silver and platinum peak against a gold price peak. Gold is still moving up and is relatively cheap still as the energy companies peak against it. So you can't say that uranium or natural gas necessarily has more leverage than these two by looking at the numbers I presented here. They do have more leverage overall, usually. But silver and platinum still have a lot of leverage because they're being priced at gold, and that ratio is compressing against gold at a different time when gold is accounting for all the money in the system. When gold accounts for the money in the system, it's at a much younger or earlier stage when the energy companies seem to peak against it. So I just want to make sure that's clear that all of these are incredible values, and I'm invested in all of these. The mining companies, the oil extraction companies, whatever they are, they all provide leverage to these numbers. Now, you have to make sure that these numbers are so ridiculous and they're so cheap that I take the least risk bet on a lot of it. I have a lot of physical precious metals. I know that that will give me a return. I know for a fact it will. A mining company, an exploration company, you don't know that you're going to get that return. So if you have the biggest bull market sitting in front of you, I have a good chunk of my money riding on the least risk way to play it. The physical metals. Physical platinum, physical gold, physical silver. I do have some money in royalty companies. I do have some money in the mining companies. Royalty companies are probably the second least risk way to play it. Then the mining companies that produce, then the developers, and then at the end is the explorers. What I'm going to tell you is make sure whatever you invest in does track the underlying commodity and gives you leverage. If it does not give you leverage and it does not track it, I'm not talking every single day, but it doesn't track it overall, you've got to be careful. because we're in the game. We know this is a big move that could potentially be coming, and I want leverage to that move. I want it to work. If it doesn't work, that means your money's not working for you. That's what I'm talking about. So these are all still very good opportunities. I still think uranium is a very good deal. I think platinum is a smoking deal, and I think silver is a good deal. Those are all very good deals. What I would be buying myself would be uranium and oil still, because we've seen some equities pull back quite a bit in the oil sector. And I would still buy. I haven't bought any platinum yet, but when it bottoms and starts to turn up, I'm going to buy some more physical platinum. One, because I own a bunch of silver, and two, I want to beef up that platinum side. Because I think when it starts to take off, I don't think it's going to come back down. So that's my opinion, guys. Again, that's just my financial opinion. Do not take it as advice, but this is what I use to track valuations. This is what allows me to figure out what to invest in. And it doesn't mean that I pile all my money into one thing. I still diversify. I still pick up other things when I think they're cheap. And the equities might pull quite a bit back versus the commodities sometimes, and maybe that's where I'll put my money. Wherever the best value is, that's where I'm going. The silver equities have pulled back quite a bit, and some look like they're putting in some bottoms. I wouldn't be adverse to cost average in a little bit of money down there. And I've been doing that with some of the royalty companies. So I'm not afraid. I'm a long-term investor. Things get cheap, I buy a little bit more. And then I just hold on. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.